Economics and finance. Strengthened economic resilience and the neutral rate. Recently, the US economy has shown remarkable expansion despite high interest rates. The GDP rose at a robust 3.4% annualized pace in the fourth quarter, and the labor market created a significant number of new jobs, lowering the unemployment rate to 3.8%, a decrease of 0.1 percentage points. Amid these real economic achievements, inflation is still on a slow decline. Market concerns rise every time hot economic news emerges, fearing that the Federal Reserve might start cutting rates later than the current scenario suggests. Concurrently, both the stock and bond markets show weakness. However, contrary to the logic that the Fed might delay rate cuts or even raise rates due to a hot real economy, a recent argument gaining traction suggests that the potential GDP or the economy's resilience is stronger than we think. If true, it's possible for the economy to continue expanding while inflation steadily eases, allowing the Fed to proceed with rate cuts supported by calming inflation. The first background to this argument is the recovery of supply chains. The supply chains, which collapsed during the COVID crisis, are recovering, leading to increased production and employment without necessarily indicating an overheated economy. Secondly, labor supply, especially with the increase in immigrants, is growing, and wage pressures are not intensifying. This allows the economy to expand while inflation eases, indicating an expanding but not overheating economy. This is an unexpectedly unusual economic situation. The expansion of labor supply that began after the COVID crisis is ongoing. With ample labor supply, the most worrying inflation driver, wage growth, is slowing down. Average hourly earnings in March rose by 4.1% year-over-year, lower than the 4.3% in February, showing no signs of structural inflation where inflation and wage growth spiral upwards together. Thirdly, productivity improvements continue to rise since the fourth quarter of 2022, with significant factors contributing to further improvements. While the exact reasons are not yet clear, it could be due to reduced unnecessary movement or effort thanks to the increase in work from home, or the advancements in the IT industry enabling non-face-to-face interactions. Notably, the rapid development of AI technologies like ChatGPT is expected to significantly enhance worker productivity. Productivity improvements are a boon as they can increase wages while stabilizing inflation, allowing the market to supply more goods and services at the same wage level. Such improvements in the economy's resilience can also be explained by the neutral rate. The neutral rate is a theoretical level of interest that allows the economy to stay at its potential growth rate without inflationary or deflationary pressures. It's not observed in the market but estimated logically. Bill Dudley, former president of the New York Federal Reserve, mentioned that the neutral rate might be higher than previously thought. Currently, the Fed policy rate of 5.25 to 5.50% is not as restrictive as it might seem, indicating the economy's increased resilience. This narrative is also confirmed in the futures market. Bond futures traders are betting that inflation in 2027 will be higher than the Fed's target of 2%, necessitating an upward adjustment of the policy interest rate to achieve the target. Though the Fed's policy rate is projected to be 2.6% in 2027, the Fed, in its March FOMC summary of economic projection, anticipates the long-term real neutral rate to be adjusted upwards from 0.5% to 0.6%. The real neutral comes from subtracting target inflation rate of 2% from nominal long-term policy rate of 2.6%. Then the real neutral rate would be 0.6%. The futures market assumes the long-term neutral rate will be higher, betting that the Fed will inevitably raise rates by then. Harvard professor Lawrence Summers has once mentioned that the recent neutral rate has risen to above 4%, real neutral rate of 2%. Many investors, still observing the hot labor market and relentless growth rate news, fear that the Fed will maintain a hawkish stance on interest rates, driving up rates in the bond market and causing stock market declines. However, if the Fed becomes more convinced of this strengthened economic resilience, it could boldly move to cut rates despite such hot economic news.